Hello and welcome to our tutorial video on how to use the budget tracker. This is an Excel spreadsheet that will help you to be able to manage your finances on a bi-weekly or a monthly schedule. So every 2 weeks or every 4 weeks you will be able to determine how much money you should have coming in the bank and how much you'll be able to save. So let's get into it. The first thing that you'll see up at the top are the recurring monthly expenses and the non-recurring monthly expenses. What the recurring monthly expenses means are within a 2 week period, if you're using the 2 week version, from January 1st to January 14th, and let's pretend here that you get paid on the 1st and the 15th. What expenses do you know are going to happen between that period? So I'm just going to name a few types of expenses, and let's just say I pay rent on the 3rd of the month, and that rent is $550. And I also know that I pay my car note, and my car note is $300, and that happens on the 5th, and I also have car insurance. And the way I would figure out, which bills that I have between the 1st and the 15th, I can always go back to my account statements and look and see which bills I have and how much each of them approximately costs. Now, what I will say is, let's say that my car insurance might cost, $135. It is good to actually overestimate your expenses. So instead of saying $135, I might say $140. Potentially even a little bit more than that. The reason for that is it allows you to have some room for mistake and gives you a margin of error. You won't always be able to predict exactly what happens with your expenses. Now, what you'll see in this yellow cell down here is that it has already calculated all of these expenses together. So our reoccurring monthly balance as it stands, and once again you would want to go through your statements, and if you need more ideas for what reoccurring costs look like, just click in the link on the summary page. But you'll see that our recurring monthly balance is $990. And if we scroll down, we'll also see our income. So let's say every 2 weeks we make $1,200. That leaves us, and let's say right now we're not earning anything extra. That leaves us with a cash flow of $210. What your cash flow is all of your expenses, whether they're recurring or non-recurring, minus your income. So your income minus your expenses, and then that's what your cash flow is. The desired contribution level is the percentage at which you would like to take your cash flow, and how much of a percentage of that do you want to save. So let's say you want to save 65% of whatever you have left over from that bill. You can see that your estimated contribution here is that you would need to put $136.50 in the bank. So ideally, and this is probably one of the most important concepts that I can teach, is that you want to pay yourself first. So realistically, once you've gotten a pretty good gist of what your expenses are, and you've given yourself some leeway, and you've like said, oh, this is $5 or $10 more here and there, and once you've done that, you'll say, okay, I will have $136 that I need to put in the savings. Make sure immediately you put that amount into savings as soon as you get it. The reason being is this concept is called paying yourself first. That way, when you look at your bank statement, when you look around, you say, oh, I might not be able to spend an extra amount of money because realistically, I only have $73 in free cash. So last month's savings, that's pretty straightforward. Last month's savings is nothing more than how much you had in the bank last month. And let's just say we had, for this sake, $300. And what you'll see is now this cell populates, and all this is $300 plus the 136. So we're estimating that at the end of this 2 week period, you should have $436. Once again, if you didn't have anything in the bank, right, then you should only have 136 because your estimated contribution was $136.50, and that's the exact amount that you want to take and put in the bank. your actual savings. So this is probably the most important cell that you need to remember because the formulas will pull from this. So you need to enter in how much you actually have saved. And let's just say, for instance, we put in $130, and you'll see that we were short $6.50, no biggie. Now, let's go to the second, let's go to January 15th over here, right? So this is all the bills that happen between January 15th and January 30th. So we're going to have a different set of bills, obviously. So maybe here we have our cell phone bill that pops up, and that's, $100, and we have our utilities that pop up, and that cost us $300 and not $3,000. And we also have gas and food, things like that. And I'm just making up numbers here. But also, what you see with the non-reoccurring monthly expenses, these once again are all the expenses we know that are going to happen. With the non-reoccurring expenses, let's say this paycheck, we want to go buy some shoes. The new Jordans or some new Hills came out, and that's what we want to get. And let's say that cost us $80. The beautiful thing is, and you're going to understand why in just a second, that you want to enter that in here. So once again, our income is $1,200. And let's say grandma sends us some money, and we've gotten an extra $250 on this paycheck, right? And we might even enter in the notes, GMA. Okay, so now you see our cash flow is $820. Let's say, once again, we want to save, let's say on this paycheck, we want to save it 70%. That means that we need to put in $574, and we'll have about $246 of free cash. Now, if you look at our last month's savings, it's $130. The reason why is because your actual savings last month was $130. So make sure that you enter in that actual savings. And let's say, okay, so we figure out that we could put about $574 in the bank, but we also want to go on a vacation. It's really cheap vacation, and we're going to spend $200 on that. Now, if you look, our estimated contribution is reduced to $434, but we're still saving at 70%. So once again, our last month's savings was $130. I just went through why, because that was your actual savings last month. So now our new estimated savings is $564. So our actual savings, let's say we only ended up saving $500. Once again, make sure to enter in that number. Now, when we go to next month, here's the beauty. This is going to save you so much time. When you go to February 1st, that new paycheck period, look what happens. You already have the same bills from January 1st. Remember those that we figured in? You only have to get this right once, and that's for each paycheck. That's the beautiful part about it. And then from here on out, it's only a matter of entering in the non-reoccurring monthly expenses. So let's say we went on a really, we're getting ready for Valentine's Day, and that's going to cost us $100. Going to get some cheap wine, I guess. So the beautiful part about this, once again, even if you look at February 15th, you have those same expenses. The beautiful part about this is you can play around with this and figure out how much you want to save. So potentially you could say by March 15th, if I wanted to save $1,200, can I get there? And how much do I need to actually save on each paycheck in order to get there? This tool will also help you to understand what your cash flow is, how much you can save, what you are saving, what your expenses are, and most importantly, paying yourself first. This is really a first step in terms of you taking hold of your own financial power. So I hope you enjoyed the video. And there is also in the summary page some directions on how to get started with the monthly expenses and all of that. I hope it's a valuable tool, and thank you.